Hi, we've got Rene back again. By the way, Rene, this time I want you to talk just for a minute about your blog, the name of it, how that name came around, but then we'll get into some amazing stuff that none of you, this will be the first time ever that you've seen this content. It's amazing. Nobody's talking about it. This is Randy Kirk. And if you like having Rene on, that's what you need to do is hit that like button. Subscribing and hitting notify are always wonderful. And then if you really want to make me happy, join Patreon. It's only $5 a month. Rene, talk to me about your blog. I'm even having a brain fog right now where I can't remember the name of it. It's a very odd name. Tell me about the name of your blog and what it means.
Yeah, thank you, Randy. It's called Fallacy Alarm. I don't know even myself how I came up with it originally. Yeah, it became bigger than I originally thought it would be. So the background actually is that I believe that we have, compared to the investors of the past, today, it's not so much anymore about getting the information, because we have so much information at our hands, right, with the internet. So the bigger challenge is actually making sense of the information and what information you put most weight on, because you can basically justify any conclusion today with the data that we have. And usually what we humans tend to do then is we try to see in the data what we want to be true, what our dreams are, what we wish to be true, right? We want to confirm that. And that's obviously a fallacy. And I want to be aware of this fallacy every day. So this name, Fallacy Alarm, is first and foremost a reminder to myself to be aware of all my wishes and dreams and all these things, that I try to seek as much truth as I can and not fall into that trap. That's the name of that's the reason for the name.
Got it. And on the one hand, a person could easily say, oh, well, the fallacy that you're talking about is the uber optimistic fallacy, which Randy Kirk admits to being a member of that group, where I am definitely looking for ways to prove that my crazy, you guys would all agree, right? I mean, my analysis about where Tesla's headed has got to be something that I did while I was smoking something. And I've never even had, believe this or not, I've never had a marijuana cigarette. Anyway, but the fallacy thing could go both ways. So you could have people that are shorting Tesla or negative on any given stock or negative on the economy that are believing fallacies on the negative side as well.
Absolutely, yeah. We need to try to find the truth. Yeah.
Okay.
No matter if it's too optimistic or too pessimistic.
Exactly. All right. So now you've got some slides. Could you go ahead and share your screen and we'll talk about your passion, where you're most passionate today?
Sure. Yeah, we can do that. Let me quickly share my screen here. Okay. Can you see this presentation here?
Looks great.
Yeah. Okay. So, Randy, I'm sure that you and many of your viewers have a very deep understanding of Tesla. And so when I got your interview invitation, I started thinking about what could I tell you and your audience that you don't already know? And I think the best thing for me to talk about would be how Tesla's business model will in the future change from a hardware sales to a services business, and then what the potential of some of these services would be. So what do I mean by that? Today, Tesla is basically a hardware business. Every quarter, it's about how much metal are they selling in the shape of vehicles and energy products, and then how much revenue and margin they generate with that. And I call that a volume times average sales price model. And in the future, this model will be morphed into a fleet times average revenue per user model. So that means it will still be relevant how much product they are shipping every year, but it will become more and more important how much of their product is actually out there for them, generating income for them. And
so this is would this be sort of similar to either the SaaS thinking or the subscription thinking? Is that kind of where you're going?
Yeah, that's an aspect of it, but I think it's only part of it.
Okay.
Because this whole services model it's not something unorthodox or groundbreaking. Like big tech operates, like most of big tech companies operate like that, and also Legacy Auto is also operating a fleet-based business model. Like they make most of their money with the loans business and also with the aftermarket business. So for a company like GM or Volkswagen, it matters more how much cars are on the road than how much they are selling every year. And I think over time, this will become more relevant for Tesla as well.
All right.
Yeah. So, yeah, you can see here Tesla's current and future product lineup on the right side. And for the next 10 minutes or so, I will focus on the second column here. That's the financing, the insurance, and the software opportunity. And that will be a very high level sort of elevator pitch version. I've written a lot about this on my newsletter. So yeah, if you're interested or any of your viewers is interested, check that out at fallacyalarm.com. So let's start with the financing opportunity.
Sure.
Legacy Auto, you can see that here at the top left chart. They typically generate 10 to 50% of their profits through their finance division. Their loan volume that they have outstanding at any given point in time, that's usually an entire year of production. So a company like Volkswagen, for example, they sell 10 million cars per year. They also have 10 million loans on their book at any given point in time, right? Mm-hmm. And that is extremely attractive. So you can see that here at the bottom left chart, that they typically generate 2 to 4% in interest margin from this loan balance. And that includes all operating expenses that they have in this finance division. So that's very solid. If you compare that to a commercial bank, for example, they may be at like 2% max. So very attractive financing business.
Wow. The
question is then, why are they able to do that? And this is about economies of scale, and it's about access to cheap capital. Because banking is a commodity, and people always go with the cheapest option. So the cheaper you can operate this business, both from like an operating cost perspective and also from an access to capital perspective, the more successful you will be. And Tesla has so far not been in a position to do so because they did not have many cars out there, right? They have like maybe 4 million cars out there. Volkswagen has like 100 million cars on the road right now, right? So so far they weren't in a position to do that. And Tesla did not have an investment grade credit rating for the longest time, which limited the access to cheap capital. And both of these two things are changing right now. So they got the investment grade credit rating, and they're becoming a true mass market manufacturer right now. So I think this will be a meaningful driver for them in the midterm. And the question is then, how big can this be? So let's if we fast forward a couple of years, let's say towards like the later half or to the end of this decade, I can imagine that they will have like 5 million loans on their balance sheet. And at an average sales price of $40,000, there would be a loan volume of 200 billion. And if we assume that they can then generate 2.5% margin on that, there would be $5 billion in operating income. And we can translate that at a 20% tax rate and today's share count to like $1.50 EPS. Hopefully by then, earnings per share will be much higher, and this will not be like a big portion of their earnings per share, let's say in 2028. But from today's perspective, it's actually quite encouraging to know, okay, they make $4 EPS this year, perhaps. They will have, like, they can easily add in the midterm more than $1 to this with a lever they haven't even pulled yet, right? So that's like one additional pillar to the earnings growth story here, the financing opportunity.
Now we know, of course, that Zach has said that they do have, it's all set up. They are already doing some leasing and some lending now. Exactly. In particular, I think in Europe.
Yes.
But that it's all set up. He says it's just a matter really of flipping a switch and they can be as big as they want to be in this category.
Exactly. Yeah.
All right.
Okay. Let's go to the insurance opportunity. So that's a commodity as well, just like all financial services business effectively. So the most successful companies will be those that can A, acquire policies cheap, and B, that can manage them cost efficiently, both from like an operating perspective in the administration of the policies, but also from a expected loss perspective. How many claims do they have and what do these cost? And the better the insurance company is at doing that, the higher their return on capital will be, and then the market will give them a valuation premium on top of the invested capital. So you can see here at the bottom left chart how return on equity for the largest property and casualty insurers correlates with the price to tangible book values that these companies get from markets. See a nice correlation here, and I've highlighted Allstate and Progressive. Those are large car insurance companies in the US. So you can see they generate like 15 to 25% return on equity, and then markets give them like a 2 to 5 times multiple. So this multiple effectively is the value created by the insurance company on top of the invested capital. And so far, car manufacturers have not been able to enter this insurance market like they've done in the financing business. It's just a tough business to operate because you're not just selling loans and managing them, you also have to manage risk. And yeah, it's just a more challenging, more sophisticated business. And I think Tesla is in a great position to change that and be the first OEM to actually have a meaningful insurance business. And why do I think that? First of all, Tesla they have a direct distribution model. They own the customer relationship with the end customer. That legacy auto does not have that. And the big insurance carriers, they also do not have that, because dealership, they sell the cars, and that's a very decentralized process. Tesla is virtually the only manufacturer selling at scale straight through an app. And I can imagine that's quite easy for them to add in a step for the customer to then buy insurance as well. And I think that's a huge advantage because, again, it's a commodity, and the most expensive part of it is actually acquiring the customer. So a customer relationship in a financial services business is extremely valuable. For reference, Allstate and Progressive, they pay on average 10% every year, 10% of their revenues just to acquire policies. And that is a cost that Tesla will barely have any of that, right? So that's almost like a 10% or up to a 10% margin advantage right there. And they can either use that to enjoy higher profitability, or they can pass it on to the customer and aggressively grow the share.
Yeah.
And then secondly, Tesla has way better data on their cars. Like normal cars of normal OEMs, they don't have superior information on their own cars compared to the insurance companies. But Tesla has a lot of data on their cars, and the data is growing. And that will enable them then to undercut pricing even more because they have more information on the driver's behavior and also the repair cost of the cars. And for example, Teslas are fairly new in the marketplace. You couldn't buy most of their lineup, let's say 5 or 10 years ago. And that makes it very challenging for the actuaries of these like big insurance companies to price that. And especially like BEVs, they're pretty new in the marketplace. They don't have much information on what's the likelihood of a full battery damage and then the cost to replace it and so on. We're in very early stages here, so Tesla has a clear advantage there. And usually insurance for Tesla is pretty expensive. And then because of that reason, the uncertainty, and Tesla should be able to price that much better. And with the FSD, this advantage should even grow more, because then there will be even more dynamic pricing and also lower risk for collision. These vehicles will be safer, they'll have less claims, and Tesla will have superior information on that.
Yeah.
And then
That's true. And Tesla is constantly improving their safety, not just the way that normal car companies do, but they actually take the data from the accidents. They get the data from the internal way that the car can record what's going on, almost like having like on an airplane, you've got the black box. Well, they got multiple black boxes, both on the hardware and the software side, that are generating information about how the crash takes place. And they've begun to see that the crumple zones that everybody else thought were the most important to have, that maybe that was 4 inches off. And so by moving the crumple zone a little bit, they've been able to reduce the expense of certain kinds of crashes.
Yeah, absolutely. Right. I think that it's already pretty good right now, and it will only get better. Yeah.
So you're showing that if they had 30, this is always say, if they had 30 million fleet total at a 50% take rate, it would generate $1 a share.
Yeah, that's exactly that. The idea is, how much could this be worth in, let's say, 5 years down the road? And these are just for illustrative purposes.
Sure.
Let's say by the end of this decade, they have like 30 million cars on the road. Let's say half of them take the insurance product. It would be like a 15 million insured fleet. If they generate 1,500 per year on each policy, it would be 23 billion in revenues. And if you take like industry typical loss ratios and operating expenses, you could easily justify $1 per share. And again, I think this is conservative. Well, it's maybe the take rate is a little bit on the upper end of what's possible, but the profitability at least is 17% margin. I think Tesla is probably in a position to improve that over time for the reasons I just outlined.
Right, exactly. Yeah, very cool.
Great. Then let's go to the third one. And we talked about that already in a previous video. So in the long run, I think I'm optimistic, just like you, that Tesla will be the first company to achieve a generalized full self-driving solution. But I think before, it's very challenging to value that because there's just so much uncertainty about it. And that's why I think it's more straightforward, to me at least, to think about this more from an evolutionary than a revolutionary perspective. Because I think the autopilot and the FSD beta program, it is already today a very attractive product for the customer and also for Tesla. And they're generating already a lot of revenue with that, and probably income too. So at the bottom left chart here, you can see that they generally, on average here, they have like 20 to 25,000 of these licenses that they sell every quarter. I took this from, there's a Twitter account you probably know, Troy Tesla. He publishes estimates about take rates. And if you multiply that with their unit sales every quarter, you can come up with an estimate for the FSD sales per quarter. And then in the bottom right chart, I have calculated what the revenue run rate would be based on the price increases for the FSD package. So as of the fourth quarter of last year, this was already north of a $1 billion revenue. And the crazy thing is, we do not see that in earnings, or most of it, because they bury that in deferred revenue for accounting reasons. Like it's not a complete product yet. They have promised full self-driving. They haven't delivered on that yet, so they cannot book the revenue, but they have received the cash. And I think that's what matters most. And if you look at this top right chart here, the recognized revenue is only half of what the true revenue is. So there's $500 million in revenue in 2022 that never made it into the income statement. And if you assume that the margin is probably close to, I don't know, 100%, or at least very high, and you just tax affected and then divided by the number of shares, that could easily be like 10 cents of EPS, right? That we do not see yet, but it is there.
Right.
And I believe that as the capabilities improve, as they roll it out to more customers, more jurisdictions, there are rumors now, for example, that they will provide it in Europe soon. I think both the take rate and also the price of this will increase, and this will likely be a multi-billion-dollar business even before the first robotaxi ride takes place.
Yeah, I think I said this on a video last week. I think that the fact that the European agency that's responsible for making the decision about whether Tesla can use FSD in Europe, the fact that they've moved up their expected approval date from January of 2025 to January of 2024 was not done in a vacuum. Something happened. Somebody is talking to them from Tesla about their progress or about their expectations that caused them to realize they need to move up their decision date. So I could be wrong about that. Just trying to follow the dots, folks. but it would appear to me you don't just all of a sudden, these federal agencies, these European agencies don't all of a sudden go, you know what? I think we're going to give Tesla a real benefit here and move up this decision a year. I don't think it came in a vacuum.
Yeah, it could. Maybe there's some signal there that this is progressing better than what people thought before. And just as an interesting side information, Mobileye is also rolling out their product to the Polestar 4, and that is also sold in Europe. So yeah,
another Geely company, Geely, whatever however you pronounce it. Yes.
Yeah, exactly. Yeah, and again, then the natural question for me always is like to quantify. I always want to quantify it. So what can it be, even if it doesn't become a robotaxi?
Yeah.
So on the last slide here, those are two screenshots from research pieces that I published a couple months ago. You can basically look at this from a fleet perspective or from a unit sales perspective. So either you ask, okay, how many vehicles are out there? How many of those will likely take FSD? And then what will the annual subscription fee be? Or you take a unit sales perspective, how many vehicles are sold every year? And then how many of those will buy the license also, like as a one-time purchase. And I don't want to go into too much detail about these numbers. This is just for illustration in the US in maybe 5 years or so. But I think these numbers to me illustrate that before even we will have robotaxis, Tesla's FSD program can totally generate like 5-10 billion in operating profits, just from like a subscription model, for example, or from like selling it as a very sophisticated ADAS solution. And that's just for me an important consideration. I don't need to have this super optimism about robotaxis in the near term, because this is a very important pillar to the whole EPS growth story, even without that.
No, I'm not going to take a lot of time to, like you said, to get into your details here, but would we assume, however, that if the robotaxi thing doesn't happen for another 2 years, I mean, and we just keep getting the promise of robotaxi, even though FSD is valuable on its own, wouldn't we have to anticipate at some point, if in order to get these kind of take rates, that the $15,000 price tag would have to come down substantially?
Yeah, it depends on how good it gets. I can imagine that it at some point it will just be so compelling that people will use it more and more. And I think over time its capabilities will also trickle into the broader population. And it just takes time for people to trust these systems. And I think there's like a natural inertia in this, that people not immediately jump to a new technology, especially one that is potentially dangerous to them.
Dangerous,
But if you look at people in California testing this, I mean, if I wanted to buy a new car now, I would certainly buy this if I had the access to it, because it just looks extremely exciting to experience.
So using myself as another example, we bought our Model Y 2.5 years ago, and we did get the FSD. But it was only 8,000 then. I'm not sure if I had been faced with that same question 2.5 years ago and it was 15,000, I'm not 100% sure I would have gone for it. Now, again, maybe with the improved capabilities where it's almost good enough for robotaxi, but still is being put off, maybe the $15,000 number is is more reasonable, but maybe I don't know about the 20% take rate. But even so, your point is well made that this is a valuable part of the company that probably isn't being priced into the stock.
Yeah, that's my perception at least. And I think we should also not underestimate how quickly this evolves. And the more cars are on the road, the more miles are collected. I think the pace of iteration on this is very fast, and that will also show in the functionality over time.
Absolutely.
Yeah, this was a quick summary on a few aspects of the Tesla story. Again, you can find the details on my website. You can also subscribe to get the latest articles straight to your inbox. Not just Tesla content that I do. It's also like I have a macro perspective too, because I think like a comprehensive investment process, in my opinion, considers both. And I share that at fallacyalarm.com. So if you or your listeners are interested, then check it out.
Perfect. So when you started out, your first slide was saying they'll move more towards being a services company than a hardware company. Do you think there will be a point at which, like Apple, that the actual profits become greater than the software and or services profits become higher than the overall hardware business?
Absolutely. I think that's where the company is headed. I think every big company is there at some point. And you can see that already in Elon's comments. He mentioned once before that, or a couple of times before, that FSD is for him the difference between Tesla having a value greater than zero or not. It's a very provocative statement.
It was a provocative statement. He never provokes. He never uses statements to provoke people.
Yeah, I think, but directionally, I think that's how he thinks about the company, and I think that's the right way to think about the company, because the fleet out there eventually, that they will have like dozens of millions of vehicles on the road, that is a value in itself, and they'll extract value from that, and over time that will be more important to the Tesla story than, oh my God, how much gross profit have they made on their like 300,000 cars every year. I think people focus on that now for good reasons, because it is what they're doing. But if someone, for example, shows like a 2030 EPS model where they assume certain market share, and then, okay, how much vehicles are that, and then what's the gross profit and what's the EPS? I don't think in 2030 anyone will value Tesla based on such an approach. So it's kind of pointless for me to do that right now. I'm more thinking about what is the long-term trajectory for the company, how may the business model look like in the future, not trying to be carried away by too much optimism and potentially delusion, but I think there's something brewing here that will be very important.
Yeah, and you didn't even get into supercharger and megacharger revenues. You didn't get into arbitrage revenues from all the megachargers that will be going into these big utility-sized situations. You didn't get into all the revenues that'll be coming in from Tesla themselves as a utility. So yeah, there's tons and tons and tons of potential services and non-hardware profits coming in the future. Yeah, so really, really good. As you point out, nobody else is really going down this stream of thinking. That's what I love to have. I love to have guests on who have a different point of view, so we're not just stuck in a certain direction with regard to our thinking. I've made the argument, I will continue to make the argument that if Tesla only had cars, trucks, and energy storage solutions, if that's all they had, they will still be bigger than Saudi Aramco and Apple combined by 2030, maybe even sooner. So this is all on top of analysis that suggests that they could do probably on the order of 1.5 trillion in sales with 20%, 25% margins by 2030 just from hardware. So this is all on top. I'm not a number bull. Who would ever say that? So Rene, super happy to have you on for these 3 shows that we've done together, and hopefully you'll have more brainstorms and we can have you back to to help the audience become even more bullish about Tesla. I don't know if that's what we really want to accomplish. So again, thank you for being on. Folks, if you like Rene's analysis, please hit the like button. Please subscribe and hit notify, because there's a massive number of additional great shows like this one that are coming up. And if you look in the information below, you can read about what's coming up, and then that'll convince you should hit notify. And then, of course, I'd love you to join Patreon as well. Again, Rene, thank you so much for being on. And for those of you in the audience, it's been great talking to you.
Click the link below to get your paperback, Kindle, or audiobook now.